Hi, good afternoon, members. First of all, I would like to thank Alex and Nicholas for the very informative session and also very lively Q&A session. I think it will be quite difficult for me to match up to your level. I hope I'll try to do my best. Yeah. Okay. Members of the MIA and also guests of the MIA, good afternoon to you. And for me, what I'll try to do is to cover this session in about 10 minutes, and then we'll come to the next, which is the panel discussion session. Just a matter of quick introduction. I'm Leonard, and I'm the partner of the Deloitte Southeast Asia Valuation and Modelling Services, and I'm also currently a member of the MIA committee member. So I have about 30 years experience in financial advisory, and hopefully today I can share some of my views and insight on the ESG valuation with all of you. Before this, I also was a co-author together with Daniel Tan on the consideration of ESG in business valuation, which was published by MIA in 2022. And hopefully today, we can share some of the perspective in that article and plus some of the recent update as well. So as mentioned earlier, today I will try to cover the ESG, and probably I will use the word interchangeably to sustainability as well as the point highlighted by Alex just now. Then the panel discussion session, we have both Alex and also Nicholas back on for the discussion to share their views from the standard setter perspective. And also we have a practitioner as well, Jay and Emily, to share their views from a practitioner point of view. All right. So without further ado, I will start off with the presentation first, then we go to the panel discussion. In terms of the areas that I'm going to cover today, very briefly, I will talk about the global and the local ESG development. This followed by the update on the standards, which Alex and Nicholas had already alluded to just now. And also we will talk about the consideration of ESG in our valuation approach, mainly the income approach and also the market approach. And finally, highlight what are some of the current challenges in the ESG, considered ESG in valuation. Right. First, in the next slide, we will look at what are some of the current development that we have noticed in the last few years. So in the recent years, sustainability and responsible investing has become important, and also it's transformed the investment landscape. So ESG, as you know, has become a key pillar for investment decision, financing, and business strategy, as well as corporate governance as well. So globally, we have seen that significant capital allocation to support sustainable practice. The evidence continue to increase to show that the value of the ESG asset being managed has increased compared to last year. In Southeast Asia as well, we can see that the amount of the fund flow has also increased. But unfortunately, in terms of in the global context, the amount of ESG fund flow decreased quite significantly compared to last year. And this is mainly due to some of the crisis that happened, geopolitical crisis that happened, and also high interest rate environment where certain policy changes that resulted in those patterns that you see. Hopefully, this is temporary and not going to be prolonged. And also the number of M&A deals, green M&A deals has increased in the past. So in terms of the ESG trend in Malaysia, where we can see that the ESG trend has also increased in Malaysia, whereby in Malaysia, many companies have started to embrace ESG in their evaluation. Based on one of the studies that we saw, about 70% of the companies surveyed have either started or have considering starting ESG initiative. So this is a very good move and a positive move. All right, moving on to the next page, just very quickly, just to share with every one of you in terms of what are some of the key development in terms of the standards, right? As you can see that there are quite a lot of development in the standards, which Alex and Nicholas probably will discuss a bit more in our panel discussion later. And from what we can see in the market here, IVSC have actively, involved in this area. A couple of perspective paper has been issued back in 2021 and 2022. MIA as well, which one of the articles that we have published that talk about ESG for valuation. At the same time, ISSB also has been formed as one of the standard setter for sustainability disclosure. And back in the local scene, we can see that Security Commission also played a very active role in launching one of the consultation paper, which is supposed to be a proposed national sustainability reporting framework for the country, right? And I think for IVSC, Nicholas has already shown just now in terms of the update, which have highlighted ESG in the new standard that going to be effective in 25. So these are the development, and with this, we probably have a bit more guidance and reference point for future evaluation. So for here, I would like to also take a poll as well to get your views in terms of the current level of standard, whether it is supporting in terms of providing sufficient information for you to conduct the evaluation. Okay, so the next page that we have here is to demonstrate that in a couple of instances, how we can consider ESG valuation factor in the valuation. I know that many of you are not valuation practitioners, right? For 50% of you are from accounting background, which may not have performed valuation in your day-to-day work. Perhaps we just give you a flavor in terms of potentially how some of these ESG factors can be considered in the valuation. So in this case, IVSC in the perspective paper have highlighted that based on the market approach, which is based on comparable companies, one of the possible ways to how we consider ESG in valuation is to identify the right asset, with the ESG factors or criteria before you make the comparison. So once you have identified the company in the similar profile based on their ESG criteria, then you make comparison to compare them, and then you then look at the company, the target company that you value, and try to benchmark to those comparable companies that you have selected based on the ESG factor that you have considered. Then the next is to calibrate some of these market input that comparable company when you make comparison to the ESG impact in the valuation. So in terms of, I think there are a couple of studies in the market to show that the positive correlation between ESG factors and also the market multiples. And what, based on the research, I'm sure you can find a lot, but Deloitte has also done a number of surveys which shows that there is indeed some positive correlation between company having good ESG rating or grading, vis-a-vis having a better earnings multiple compared to their peer. So that is one of the findings that we have found. The other finding that we have found also shows that in terms of the potential acquirer, they are prepared to pay a bit more premium for companies that has a better ESG score. So these are the responses that we got from the market. Okay. So moving on to the next page. So the next page shows that another way of considering ESG factor in valuations, and in this case will be the based on the income approach, where typically we will use a discount rate and as well as discounted cash flow as well. So IVSC this propose or this suggests that in looking at the discount rate, potentially we can consider the beta factor, which is considering ESG in choosing the right comparable company, so that we have a right comparable company with a similar ESG factors when we make a comparison in order to derive the discount rate. Another way to consider the factor is to look at potentially having a premium onto the discount rate in order to take into account of some of this premium or some of these risks that are arising from the ESG or sustainability factors. So if you look at some of the studies that we can get from the market, for example, the MSCI World Index and also MSCI Emerging Market Index, the study shows that companies that has good ESG score indeed, have a better cost of capital, which is the lower discount rate compared to company that doesn't have a good ESG score. So there are some correlation in this case, and therefore this is one method that we can consider. The next page will show another way of considering ESG factor in the valuation. In this case, I believe that this is one of the favorite methods that is being used by practitioners currently in considering ESG factor. This is where we try to quantify the ESG factors into the cash flow itself. In this case, I personally find that it is more transparent and easy to quantify, and we are able to see the direct impact to the cash flow. So in case this typically applicable to some of the ESG factor, which is very, very visible, or certainty of impact to the cash flow is quite certain, then the adjustment is possible. Otherwise, it will be quite difficult to do so, and we have seen that many practitioners also fall back to adjusting the discount rate to take into account of the ESG factor in this case. All right, moving on to the next page. This is my last slide. Here, what I would like to do is to show some of the current challenges that we see in terms of performing valuation in considering ESG factor. Hopefully, I think with the development of the standards and also more approaches, more valuation is being performed, and over time we are able to have more data points in doing the ESG, in considering those factors in the valuation. I think some of these challenges that you have highlighted here is quite common to you. For example, the lack of information, which is currently a data issue at the moment, right? For us to do valuation, which we all know that data is key. Another point, of course, is the standardization of the approach, and followed by information to consider the social or the growth factors. And also, ESG sometimes is quite specific to a company, and therefore it will require certain knowledge of the industry as well. So therefore, a use of industry expert is also quite important. So I think these are some of the challenges, but I'm quite confident that these challenges can be overcome due to the overtime development of the standards by various parties like IVSC, ISSB, and also availability of more ESG rating that is available in the market. As you can see from in the Malaysia perspective, and the country as a whole has taken a very good initiative in implementing a sustainability approach practice for the country. For example, in Malaysia, our National Industry Master Plan 2030 has a mission to achieve net zero, right? And a few initiatives have also been taken place. For example, establishment of the ESG framework and also ESG guidelines for SME. So these are all very positive approach, and we are more moving towards and try to quantify ESG in the valuation. Welcome back again, panelists. Without further ado, I will start off the discussion session. So in this discussion session, we have approximately about 35 minutes for us to to hear the views of our panelists on some of the questions that I'm going to pose, and then we'll follow with a Q&A session. Yeah. So the area that I'm going to cover in this discussion will include current challenges from a practitioner point of view. What are some of the in terms of the standard that supports the quantifications of ESG for valuation, current valuation methodology and approaches, and also in terms of the level of information availability in the market. And another point that I would like to cover in this discussion will be the acceptability of the outcome of ESG by various stakeholders, followed by the training required that our panelists thinks that what we need to do in order to get better and get ready for such evaluation. All right. So without any delay, I will start off with the first questions. So my first question will be directing to our fellow valuation practitioner. So the question will be, as a practitioner, what are the current challenges in the journey towards quantifying ESG in valuation? Can I have Jay to answer the first question, and followed by Emily? Thank you.
Yeah, thanks very much, Leonard. Good afternoon, everyone. It's a privilege to be here. Leonard, I think it's very interesting you're starting this by asking about challenges, right? Because a lot of people would have started talking about how to value it, where to get data, what is the framework, and so on, before maybe having a session at the end about challenges. But I think the way you're doing it is really is provocative, and it's also important because actually I think the first step really in getting this right is acknowledging the challenges, right? So to me, it's not about whether it's important. I think everyone seems to be saying, yes, ESG valuation is important, but really, how do you frame the question correctly? That to me, I think, is the starting point. A lot of people, start going straight into how do I value greenhouse gas emissions, for instance, or health and safety practices, or quantity of waste to landfill. So you go straight into that. But I think before even the how is the what. What exactly are you valuing? And maybe associated with that is why you're valuing it. So I think I'm really hoping today is a session to explore that with my fellow panelists. But what I will say before we talk about what is ESG valuation is what it is not, right? And what I want to put this on the table up front. What to me ESG valuation is not a separate add-on that you do onto a conventional valuation as an afterthought. So one of my pet peeves, and I sometimes see people claiming to have valued a business or a company with ESG considerations, is that they do everything that you would normally do, standard DCF multiples valuation or whatever it is, get a value, and then right at the end they say, oh, this good ESG company add 5% to value, or bad ESG company deduct 10%. That to me is not what you should do. So yes, there are challenges, plenty. And you've touched on some, Leonard, the lack of a universal definition. I think Alex also alluded to what I would call swaying political and ideological perspectives, especially in places like in the US, through to, I think, what are very natural uncertainties as with any nascent technical endeavor such as this, right? When you talk about valuations, we're used to a certain level of rigor, certain level of discipline. So when you're dealing with something new like this, and where you're using short-term data on long-term analyses, so these are some of the challenges. I don't have all the answers, and I don't think any of us would claim to, but I think we have to start somewhere. And I'd say IVSC is doing good work right at the forefront of this question, and it's conversations like this that matter, Leonard.
Thank you very much, Jay. Emily, can we have your views on this?
Yeah, sure, Leonard. Hello, everyone, all the participants. Good to see you today. I will add on to say that one of the key challenges in ESG valuation is really determining the what. And what is it to be incorporated from ESG factors in valuation. It's quite diverse. Diversity in ESG issues across the different industries are actually quite huge. So therefore, to determine what is it to be incorporated or separately to account in a valuation, I think is a very first topic and challenge that we encounter. Because over time, market multiples or discount rate in the same industry, i.e. the beta, would have reflected the risk from ESG of the same industry. So therefore, it then boils down to a judgment to then decide what is it exactly that we will separately account in the valuation. I think that's the key challenge here. Of course, Leonard, yourself, and also Jay, we talk about data availability. Yeah. The data availability comes from the diversity of ESG factors in valuation. So very often, we will require data expertise or technical expertise to help quantify the impact of ESG factors on, say, capex and cost. So I think that is the key challenge. Yeah.
Thank you very much, Jay and Emily. I mean, for me, I mean, it's good to reaffirm my understanding as well, as a practitioner. I mean, I have a very common themes that both Jay and Emily mentioned, in the lights of, we must know exactly what we are valuing, right? We must know, always ask what and how to do about it. I think valuation is it's a lot of art, but also very scientific as well. So we must be very certain what we are actually valuing. And also to Emily's point about diversity due to the industry, and also the use of technical experts are very relevant, and resonating to what I always think about. Okay, thank you very much. So I will move on to the next question, which now I would like to, turn to our standard setter, both Nicholas and also Alex. So the question to both of you here will be, does the current level of valuation standard supports the consideration of ESG in valuation? Alex, I understand both yourself and Nicholas has also dived in quite a fair bit of this just now in your presentation. Perhaps, here you can give us a bit more insights in what you think about this. Thank you. Over to you, Alex.
So maybe I'll start off. So first of all, when you look at the standards, and taking on Emily's point as well in relation to ESG, we did give examples of environmental, social and governance factors. So for example, under environmental, we have air and water pollution, biodiversity, climate change, which is both current and future risks, clean water and sanitation, carbon and other gas emissions, deforestation, natural disasters, resource scarcity or efficiency, i.e. energy, water or raw materials, and waste management. Social factors are slightly more difficult. It involves things such as community relations, conflict, customer satisfaction, data protection and privacy, development of human capital, employee engagement, gender equality and racial equality, good health and well-being, human rights, working conditions and working environment. And just referring back to Leonard's point, the E we have a lot of data on. In terms of the social and governance factors, we're still in data gathering stage. So that's why we very much state that they should incorporate ESG factors. One second. ESG factors to the extent that they are measurable. Not everything is measurable. At this point in time, we do recognize that we're in a data gathering stage. What we don't want is people putting their finger in the air and making a number because they have to. Also, I would say that within ESG, professional judgment and professional skepticism is extremely important, because even looking at the rating agencies, they're not consistent in the way that they report different firms and businesses. In fact, you can almost skew your results by which rating agency that you look at, and therefore at the moment, the valuer really needs to take this into account, though we are trying to work collaboratively to get consistency across these. In terms of governance, governance is quite difficult because you probably won't be aware that a business has a governance issue until they've resolved it. So it's going to be extremely hard in the ways that we incorporate governance, because it could have such the effect on the value of a company that they would probably deal with a lot of these internally, but very much still at a data gathering exercise. But I'll go over to Nicholas to maybe add some more detail in relation to that.
I would just say that ESG was a topic of intense discussion as the boards were debating the changes to the IVS. I'll offer a somewhat provocative statement, is that the best way to do a thorough valuation that includes ESG is to make sure that you abide by the full process of the valuation, including, IVS 100, 101, 102, and so on. Because there's a pressure, in particular when it comes to ESG, to quote unquote do the right thing, and sometimes what is understood as doing the right thing may not be in the scope of evaluation. We've seen we've seen a pressure to include externalities into evaluation of an asset that may or may not be appropriate. So again, I would say everyone involved in the valuation should abide by all of the steps in the valuation, and ESG indirectly is not only in the appendix that treats explicitly about ESG. It's throughout the standards.
And if I could just add one more point to what Nicholas says, remember ESG at the end of the day is data. And you're all used to using data, you're all used to incorporating data within your valuations, and therefore the same requirements for any data in relation to ESG should apply to any other data that is used in your valuation. It's not a separate category as such, it's just that we're looking at it separately due to the regulations that are coming into it. But be careful of double counting, particularly if you've got assets incorporated in your valuation, because ESG can be considered on an asset basis as well as a firm. And that's one of the difficulties as well with the market approach. We don't have a lot of comparables out there in the market at the moment, and therefore there are other approaches that may be more effective.
Thank you very much. Thank you very much, Alex and Nicholas, for sharing that. So I guess from my perspective, the key takeaway point that I gotten from here is in terms of considering ESG in valuation, right? It's not in isolation. We need to consider the whole valuation process as what we typically have looked at, and therefore going back to the standards, looking at all the standards regarding to valuation is key, not in isolation, just ESG. So I think that is a very, very good key takeaway. The second point about in terms of it's important to consider ESG, but we are not trying to value for the sake of valuing, but it should be something that is measurable, right? And also a professional judgment is very key in determining such factors. Those are very, very good key takeaway, right? Yeah. So for all the participants and audience here, if you have any question they would like to ask, please post your question in the pigeonhole. Okay, thank you very much. I'll move on to the next question. In this case, I will try to look at it from a perspective of valuation approaches, and I would like to turn the question to Emily and Jay in terms of to find out from them as a practitioner in the market, and what are the current approaches or method that are commonly used in quantifying ESG impact on valuation. And this is also one of the questions that currently in the pigeonhole as well. So I will pose a question to Emily and followed by Jay. Over to you, Emily.
Yeah, sure, and I'm happy to address that. I guess we moved from the first question just now, what to incorporate in ESG valuation, or what ESG factors to incorporate in valuation. Now we are moving to a question more relating to how do we incorporate ESG factors in valuation? In my view, ESG in business valuation does not represent a new valuation method. We are still applying the common methods, which is the income approach, or more commonly known as the discounted cash flow approach, and market approach and asset-based method. My approach I would look at ESG valuation and how to incorporate them in two different ways. One that is a more direct approach, which is typically a more preferred approach because it's more transparent, which is then to identify what are the exact or the specific ESG factors that need to be incorporated and how is it going to impact cash flow? Is it from the perspective of revenue, cost, or capital expenditure? That we will then incorporate such into the financial projections and therefore following the discounted cash flow or the market approach. Yeah, so that's the direct approach. The indirect approach would be then, of course, most practitioners will hope we will have instant solution to say, can we just adjust the market multiple or can we adjust the discount rate? I must say the indirect approach is a more high level, is typically less preferred because it's less transparent. We do not know how the market multiples or the discount rate or the beta are exactly applied to our situation. However, it is still a method to approach. But I must say, between the direct method and the indirect method, we have to be careful of not double counting. I'll just quickly give an example. Say a company that based on my own experience on a current assignment, I can see that there are differences in the market multiples between companies that are producing non-palm-based vegetable oil versus company that are palm-based vegetable oil. All right. So therefore, you can see that they are already differences and they are already comparables from a market approach. However, if you compare two different companies in the same sector, say palm-based vegetable oil, one company may have a specific reliance on a European market where the standards for palm oil or palm products are higher. Therefore, it affects the customer base if the customers are mainly from the European countries. Hence, if you were to taking into consideration just a market approach, you wouldn't have accounted the second case where a specific European market situation. So we just need to make sure that we understand we don't double count. If there's no specific European market situation, I probably don't need to make any more further adjustment because the market multiples has already reflected as such. So I just want to caution about double counting. So there's talking about specific risk and general risk. Yeah. All right. So that's basically my viewpoint.
Thank you, Emily. Jay, over to you.
Yeah, I mean, there's not a lot to add to that, right? I mean, Emily's covered it very well. I would just say, ultimately, right, a valuation is still a valuation at the end of the day. And it's not different from how you would look at any other factors. It's just that now you have a new set of factors that we call the ESG factors. I like to think that, Emily, myself, you, Leonard, as if you like qualified valuers, we apply a certain level of discipline, rigor, and logic. Now, as long as you do that in a valuation, I think you'll be okay, right? When you want to consider ESG. And I'll give you an example. What do we mean by this? If we go down to first principles, we look at how any of these factors affects value through value drivers, let's say, right? And with value drivers, whether ESG related or not, ultimately you're coming down to the magnitude of the impact, the likelihood of the impact of these material factors. The additional thing that I like to do when we look at ESG valuations is to draw a very clear, what I call two routes. One is a consequence pathway or an intervention pathway. So what is the pathway that we're looking at to measure the impact of these ESG factors? And what I mean by this is, when you have consequence, you think of something, the company has a certain issue, for instance. If it does nothing, what is the consequence? Likely consequence could be whether it's a reduction in market share, whether it's an increase in tax or so on. Alternatively, there could be an intervention, something to rectify a position to get them back to a situation where they can continue to grow. And there are very, very, very clear examples of this. So for instance, you have banks or financiers who refuse to finance new coal projects, for instance. What happens there? If a company is in this business, they then have limited, somewhat more limited access to capital. That has a direct impact on cost of debt, weighted average cost of capital. These are things that we know as valuers. So it's essentially about translating an ESG factor into something which is very much more within the domain of a valuer. There are other things, like for instance, I mentioned an intervention capex. You could have to retrofit a building with solar panels, for example, in order to be able to maintain a certain level of tenancy or rental rates and so on. So that sort of thing has an impact on the capex. There are many other examples. I mean, the EU, as we talked about, and they've got various it's not just ordinary taxes that we are familiar with, but there are things like the CBAM, the Carbon Border Adjustment Mechanism, which seeks to impute a fair price on carbon emitted. So there are a lot of these things that we can, using the discipline that we are familiar with, translate to cash flows. So that's basically examples of approaches that I think work. Leonard?
Thank you very much. Jay and Emily, very, very good points that both of you have brought up, which is also, I do agree with the points that you have highlighted as well. And it's a practical issue. So therefore, I think over time, we will be better in those, make it easier in terms of doing such ESG impact. So moving to the next questions. So in terms of the availability of information, I think we did discuss that just now. Both Jay and also Emily did highlighted that information challenges is one of the key points, right, in such quantification. So I would like to pose the question to both Alex and Nicholas. So in here, the question to both Nicholas and Alex will be, what is the availability of information for quantifying ESG for valuation purposes? So perhaps I can start off with Alex.
That's a bit of $1 million question, Leonard, but it really depends on market to market. So that's the first thing. Not all markets will have the same availability of information. Not all markets will have the same emphasis, and some markets will be more in relation to energy, and others it will be in relation to net zero carbon. What we would do, rather than being able to comment on the whole world and the availability of information there, I would say that the valuer should look for the correct information to use in their valuation. They shouldn't feel that they should have to make up information. We are still very much in developmental stage. There's discussions how AI could even be a factor in releasing some of the S and the G. I mean, to give you a simple example of the S, one of the things we're trying to consider is you may have a multi-let building that is totally green. Everything, it's net zero carbon and everything else. However, what happens if one of the tenants comes in, is an arms dealer or a known polluter or something that is not seen good from an ESG perspective? Will that affect your rents? Will that affect your yields? These are things that we don't know at the moment. And so one of the things we've done is we've released a survey, and we should be getting the results out in the next few months. We've had over 541 respondents, because we want to understand how valuers are incorporating ESG in their valuations. And from a very preliminary look at the results, one of the things we've noticed is not every market is at the same stage. Now, whether this is due to regulation or availability of information, some markets are very developed in the way that they consider ESG and have that information. Other markets have barely started that journey at all. And a number of valuers from those markets have said, well, we don't consider ESG within our valuation. So I think the thing is, you should do the same due diligence as you would with any other data. However, not all that data is currently available. Nicholas, over to you.
I'm reminded of a quotation by Einstein, which comes in handy, about that not everything that can be counted counts, and not everything that counts can be counted. And I think this is useful when thinking of ESG valuations.
Thank you very much. Yeah, I think it's a very, very useful quotation that I'm sure I will use that for my ESG valuation as well. That's a very, very relevant point, right? Yeah, I think data challenges has been always the case, right?
Yes.
Even though when we do the usual business valuation, and to a certain extent, we are facing data challenges as well. So I think that the key here is to how best we can perform the valuation based on the availability of information that we have, and use the relevant professional judgment, and also use of the expert in helping us to understand the business, in this case, an ESG factor, in order to come to a sensible number. Right. Okay, very good. Thank you very much. The next question that which I think is quite an interesting one, that I would like to ask all the panelists. In this case, you know, having heard, you know, the method, how we do that, potential challenges, and so on, I think importantly is to also to understand that whether the outcome, you know, from our business valuation, when we consider ESG factor, whether this outcome are what is the acceptability by the stakeholder in the market. So in this case, the stakeholders are investors, for example, the analysts, and also the wider group, you know, or the public in general. And what will be their level of acceptability on the outcome from the ESG valuation. So I would like to, you know, turn this question to all our panelists here. Perhaps each of you can just share very quickly what your thoughts on this. I will start off with Alex, followed by Nicholas, and then Jay and Emily. Over to you.
Okay, I'm just going to say very simply that it's very important that the client and valuer agree what they're doing in relation to ESG. So they should very much look at their scope of work or terms of engagement and agree what is to be included and what is not to be included in the valuation, and to a certain extent what information is to be looked at. And then I would add to that it's very important that within the valuation reporting that they say what they have done. And the two should tally. If you look at it from an accounting point of view or bookkeeping, that what I say that I'm going to do in my scope of work, I should have done within my valuation report. So I think there's no easy answer to this question. The way to make sure of it acceptability to the investor or the stakeholder or the instructor of the valuation is to make sure that you agree in advance what you're doing, what you're not doing, and at the end you say what you have done. But over to Nicholas to add to that.
Not much to add. I go back to the earlier point we made, which is that paradoxically the way to do a good ESG valuation is to abide by all of the standards. And Alex made the point very eloquently. I would just reiterate that.
Thank you. Over to you, Jay.
Yeah, I mean, again, very quickly, I think in terms of acceptance, directionally, the acceptance is growing, and that is driven by the ecosystem. The investors are demanding it. You find equity analysts applying or starting to apply it. Regulators are very key to this, at least in terms of mandating things like disclosure and maybe some form of assurance on that disclosure. Rating agencies and obviously standard setters. So to me, the question ultimately should not be, you know, in the longer term, it's not just a question of, it's not going to be a question of, is it acceptable to include ESG in valuation? But to me, the utopia would be, is it acceptable not to include ESG into a valuation? That's the way I look at it.
Thank you very much. Emily, over to you.
Yeah, I kind of agree with you, Jane, more. It is not about whether to accept or not. We have to accept ESG evaluation. And in particular, in situations where negative adjustment to ESG factors in valuation, how do we convince the stakeholders on acceptance? I think it's no different falling back to reasonableness of those adjustments. Yeah.
Okay, thank you. Very, very useful tips from all the panelists. Right, I'm sure that everyone have got the point. So I'll move on to the next question. So that the next question is relating to training. Right, given that this is relatively new to everybody, I would like to open the question to all the panelists. Perhaps give me 1 or 2 words. What do you think will be, the training that is required for all of us and the audience here, including myself as well? How do we get ready in performing valuations considering ESG factor? So I'll start off with Emily, followed by Emily and Alex and Nicholas. Over to you.
Yeah, I mean, very quickly, I think just stay true to the fundamentals of valuation. That so the training that we look at, I mean, let's be realistic here. I mean, Emily, myself, you as practitioners and many other practitioners, I'm sure in the audience, we've never claimed to be experts on, carbon or labor practices or board diversity, governance, and so on. But we are dealing with all of this information, and there's a plethora of information that's coming our way. The ability to be able to dissect, use, analyze, understand this information is going to be key. So we probably need to be upskilled. I think we are going to have to use experts, but we do that anyway, right? And our role in this is we are not experts in everything, but we know how to supervise, we know how to review the work of experts. We need to upskill ourselves in the same sort of way with ESG. And finally, the term that's come up quite a lot, professional skepticism. I mean, we must recognize that people disclose, naturally companies are going to disclose things sometimes to their advantage. You've heard the term greenwashing, for instance. So I think we need to be able to see through all of this, and upskilling ourselves in this direction is key. Thanks.
All right. Jane, so following Jay's response, I would suggest that I would falling back to the income when it comes to training. I think I'll fall back to what is that we need to incorporate ESG in valuation, and is it a general risk of ESG or is it a specific ESG risk? And how do we upscale ourselves and have a better professional judgment? What is cost specific and what is general risk in terms of ESG? I think one of the very good something that we can all invest in ourselves is to start reading and compiling. There will be a lot of sustainability reporting coming into the market, starting this year and also next year. Therefore, I would urge that all of us in the practitioners in valuation to start reading all these and gain some kind of sense what is the general risk and what are the specific risks. That then will help us determine the what to incorporate.
Okay, thank you very much. The next, Alex.
Yeah, so I'm in furious agreement with all my panelists here. I mean, the first thing I'd like to go is to Jay's comment. We can't be experts in everything. We do use external specialists, and probably ESG is an area where we should bring in external specialists. We've got things moving at quite a rate. And, our duty is to understand the reports provided by these specialists. It's not necessarily to understand every single aspect of ESG. I'll then move to Emily and say that, data gathering is really important at this point in time. We should read articles, we should upskill ourselves as well. But I'm also aware that many member organizations of IVSC will be providing in-house training to their valuers at some level and will be doing training courses in relation to ESG. I would recommend that some valuers do this as well. But at the same time, the valuer can't be an expert on everything. And maybe this is an area where you can bring in an external expert and sort of limit your liability and risk. But over to Nicholas.
Thank you.
Really not much to add. And I would just point out that within the ESG experts, you have experts on all sorts of sub-variants of ESG, which further complicates. At the end of the day, it is up to the valuer to to weigh all of these sometimes countervailing forces.